Bloomberg Audio Studios. Podcasts, radio, news.
Data and earnings are painting a mixed picture of the economy. ISM services, ADP employment, they come in solid. Challenger job cuts, those jump to one of the worst Octobers on record, ruining these markets or the rally yesterday. Let's try to get a sense of direction. Bringing us that now is Rick Rieder, Chief Investment Officer of Global Fixed Income at BlackRock. And Rick, we always have you on a jobs day, and today is decidedly a jobs day that should have been. Are you just flying blind? I mean, this data, it depends what you look at. You can say the economy is great or things are falling apart.
It's funny. Thanks for having me on, by the way. It's a funny thing. I found that the industry's obsession with these individual days, and by the way, the payroll report's a great economic indicator. The CPI report, there is so much information that comes through the system. By the way, my favorite, I read tons, maybe too many, corporate earnings reports, and I look at what's happening with hiring, inventory management, receivables, et cetera. So there's still, would I rather have the data? For sure. By the way, I think the markets become hamstrung, and I think part of why the markets are acting in this sort of paranoid, what do people know, what's the information out there, manner today. I think I feel pretty good about knowing the structural direction of travel. I think the economy's in good shape. There are parts of it, it's not operating on all its cylinders, which we'll talk about. CapEx is great, high income is doing well, low income in the consumer side, not so much. But I feel pretty good about understanding. And listen, I think we have a softening of the labor market that is quite significant. And you see that, as you mentioned, the Challenger jobs report, you see that playing out. You certainly see that when I look at all the corporate earnings in terms of that. We have a softening labor market. And if we had the number today, I think it would have been reflective thereof.
Yeah, on flying blind, I couldn't agree with you more, and no one cares what I think, but Bob Michael of JP Morgan has made this point. Rich Clarida, former vice chair of the Fed, confirmed they have like 500 economists. They have 12 regional banks. They're talking to participants, to companies, to institutions every single day, so they have a pretty good handle on the economy even without it. I wonder about what you guys have at BlackRock. You have $10 trillion of assets under management, right? What kind of signals are you looking at? What kind of proprietary information are you getting that helps you in your job, Rick?
Matt, it's a great question. By the way, this morning we went through credit card data. So it's all available information. So we had a gentleman named Randy Berkowitz who drives every day. We look at what's happening in terms of, you go through the internet, you splice some of the credit card data that comes out. You get an amazing amount of high frequency data. So we'll use that. We use a series of data assimilation tools. By the way, text mining to understand what companies are saying. So anyway, we're trying, and by the way, we don't have it figured out yet, but we're trying to be pretty cutting edge around the amount of tools we use and how AI is helping us. By the way, also in things like how do you think about scenario analysis? How do you think about, the first derivative rate of change on inflation and growth? So listen, I think part of the why it's most exciting times for investing ever is the amount of tools you can utilize that allow you to get more verse around what the direction of travel in is pretty intense today. So, we're still working and trying to figure out more tools we could use, but it's so much different, Matt, than quite frankly 5 years ago, 10 years ago.
Rick, I would be very interested to know if any of that data, any of the tools that you've been using and looked at have changed some of your allocations or how you're thinking about Bink right now.
So it's a great question. Thanks for asking. So Bink, there was something that is, I think, pretty intense around. So Bink, has had a good run. We feel good about where it's going, and more people coming into it. The thing that it's allowed us to think through is today you've obviously got the way the Fed's going to interpret the data, which is not always what I agree with, but the Fed's going to interpret the data as you've got inflation that's a little sticky high and then the employment that's moderating. So we think you're in this, and by the way, not just the Fed, the ECB, the Bank of England, the RBA, they're in this point of let's sit back and watch the data. So the way we move our positions around is we've reduced a little bit of our interest rate sensitivity. We pulled some of our interest rate sensitivity out of the front end of the yield curve and say, gosh, let's just get carry. We can reduce a little bit of our duration. We've reduced a little bit of our investment grade, more than a little bit of our investment grade credit, because quite frankly, today where spreads are, it doesn't do a lot for us. And if rates are pretty stable, agency mortgages become much more interesting, and low coupon agency mortgages become much more interesting in the portfolio. So we've been doing that. By the way, we look at the data, including last night. You're seeing with the mortgage rate coming down a bit of faster prepayment. So we've reduced some high coupon mortgages. I know a lot of technical there, but some stuff moving around.
We should point out for viewers who don't know, BINC is the iShares Flexible Income ETF that Rick runs at BlackRock. Rick is going to stay with us through the opening bell into the equities trade next. This is Bloomberg. Let's bring back BlackRock Chief Investment Officer of Global Fixed Income, Rick Rieder. And Rick, can I ask you about that? I mean, is this market too frothy? Are valuations, are we getting too far ahead of ourselves here? Because I was looking at the other day, the Warren Buffett, valuation stocks market capital versus GDP. It's at the highest level, at least since 2000. And the same is true of the Shiller case. CAPE ratio, you can see this great chart here that shows you we're pretty highly valued on these two measures. Are you worried about the AI froth?
So, there's something, by the way, this is a time of year you tend to get momentum gets chased out of the markets, particularly today where you have ambiguity around some trends that are taking place. So, by the way, I don't think it's an AI bubble, and I don't think there's too much froth. And depending on where you go, if you look at some of the big hyperscalers that trade at 20 to 25, 26 times earnings, and they throw off ROE, return on equity of 30, 35, 40%, and you look at their free cash flow. I've never seen in my career free cash flow generation. We can talk about top line revenue growth. When you can have that much free cash flow generation, it allows you to do your CapEx, which is extraordinary today, build R&D, which is your future cash flow, and then you can buy back your stock. So what's happening, you have an unbelievable dynamic, and by the way, we're now about to open the buyback window, that you have this dynamic that you throw off immense amounts of free cash flow, and so there's multiples are not scary. There are parts, I see it in the private market, and I see it in some places where you're seeing businesses that have no cash flow for a number of years. How much would you finance those? So I do see froth in some areas, but in the traditional big market cap stuff, and I would say related to that, in semis, in healthcare technology, where you're seeing rapid change, but real cash flow alongside of it, it is the exact dichotomy
Rick,
of what you saw in 2002.
Why then do you have these large cap giants tapping the bond market to the degree they are, and not just the broadly syndicate market, but also raising capital off balance sheet too? If they were so confident and have such robust cash flows, is that not a concerning turn of events that they're instead building up on debt piles?
So first of all, when you look at any measure, debt to EBITDA, you look at their debt to book cap, debt to market cap, these companies are under-geared or under-levered. Their cap structure is so low in terms of leverage certainly relative to their market cap, but relative to their book cap. If you were running a big, mature company, you think about what does your normal cap structure look like, and if you're going to fund near-term CapEx over the next couple of years, if you can do it out the yields curve, which is where you see a lot of that financing take place, to say, gosh, I am throwing off a lot of cash flow, but if I can lock in these rates, and if I'm as a shareholder of any of these companies, I say, why in the world would you fund everything with equity? Or why wouldn't we put a little bit of debt, get a little bit of gearing, get your ROE higher? So I just think it's a natural evolution of, gosh, this is how you run a big company, and this is what a normal cap structure looks like.
I mean, we were just talking about global bond sales hitting $6 trillion, an all-time record. That's pretty incredible, and the return on fixed income has been great this year as well. Finally, how could we be in a world with tight financial conditions when this is happening? It just doesn't make any sense to me why the Fed would want to be cutting into this.
So you got what I would argue, there's an immense amount of cash that came from certainly years ago at fiscal monetary stimulus. So, I don't think financial conditions are great for older savers in the economy. The interest rate tool today is incredibly powerful on parts of the economy that are really struggling. Low income, small business, the housing market. By the way, the government debt, since 89% of what the government funds is in 0 to 2 year part of the yield curve, so it has a huge influence on what taxpayers are paying for debt today. So my view today, what the interest rate tool does, the idea it affects inflation. I've been saying this for months. It's very hard for the Fed to bring down sticky inflation, healthcare, education, insurance. Not terribly robust. But you do actually, if you bring the rate down, you will bring down the mortgage rate, which you're seeing play out.
Well, but not for poor Americans, Rick. Diane Swonk has said, bringing down these rates is not going to affect subprime rates, and 25% of the country is below 690 with a credit score. Also, I don't see how a lower rate adds jobs in an environment where companies are cutting headcount to try and offset higher tariffs to their margins.
So, man, I've said this for months now. I will say one thing: the Fed doesn't create jobs directly, but you think about what happens. Small business does. 44% of the hiring in the U.S. is small business. The rate's too high for small business. Second, you think about what happens in the housing market. We put 3.1 people to work for every home built in this country. If you get the mortgage rate, by the way, you don't have to get it down that much, but if you got it down 25, 50 basis points, you increase labor mobility. Your point is right. Companies, we're in a productivity revolution. Companies are going to cut jobs. But if you increase labor mobility because people can sell their house, move to another state where they get a job, if we actually put people to work in building houses, you bring down shelter inflation. The Fed can't create jobs, but you can ameliorate some of the stress that's happening because of productivity. And people talk about productivity as like AI. It is happening everywhere. We talk about freight, how we do logistics, how we do inventory management, how we do customer procurement. Productivity is exploding. We don't need as much labor collectively in the country. Bringing that rate down in the places that can actually help will actually at the margin help a labor dynamic that I think today you'll see not just what you're seeing in the last 4 months, but what you're going to see for the next couple of years.
And Rick, these conversations, and especially your viewpoint, is made all the more important. We have to ask because the beginning of last week, Secretary Scott Bessent confirmed his list for Fed picks, your name among them. How have those conversations gone?
No, I can't. I can't really comment. I wake up in the morning and I try to figure out the spline of the yield curve and what your comments about fast food versus Fed, like should we be buying this stock or that stock? That's what I got to focus on that. And so anyway, that's what I'm doing today.
Even if you're not,
it's the most exciting time to do it.
Rick, even if you're not confirmed as Fed chair, everybody has a view about what they would do differently at the Fed. What are some of the changes that you would make?
All I'll point to is what I've said for many months now is I think there's some things that you can do to create velocity in the system. Nobody borrows off the overnight funds rate anymore. Velocity happens where financing happens out the yield curve. Things you could do to keep that stability of the back end of the yield curve, to keep the mortgage rate in a place where we get real velocity, existing home sales moving. So anyway, I think there's some things that can be done that are interesting. And listen, Matt, I've said it publicly for many months now. I think if we're running break even, you can buy in the market today, 5-year inflation break evens at 2.35%. I think the funds rate should be at 3%. And I just think you could move it there, and then you don't have to go much further. I just think the price, in markets, if something's priced wrong, you get it there. I just think we can get it there, and then take another view on where are we today, and do you have to move higher or lower? But anyway, I think we could move rate a bit lower.
Well, Rick,
quicker.
It does have this feeling that whoever is next and whoever's next leading the Fed, that there will be this difference in tone. When we have this scenario where Chair Powell's term is up and we have our next chair in waiting, whoever that might be, how should that person handle that kind of lame duck gray period?
From an investor point of view?
Or just communication to the markets. How should that look when Chair Powell's term is over and we're waiting for the newly confirmed Fed chair?
Listen, I think it's tricky. I have incredible sympathy for, and quite frankly, the sanctity of what that institution is. I think what they will continue to do, and I think what they do today, is they make judgment based on, here's the data that we have to interpret, what is the right thing for the population at large in terms of managing that policy. And I really believe in this, and I certainly believe in this Fed chair and this Fed committee, that I think they're going to make the decision based on, let's evaluate the data, interpret the data, and make a decision based on that. And I don't think there's any reason to believe that happens any other way than that.
Well, Rick, you certainly do that for us, and we are very appreciative of it. To get all of your thoughts from what's going on with Bink to the labor market and beyond, Rick Rieder, thank you so much for joining us.